Let me take it across to Mahantesh as well, who's joining us on the show. Mahantesh, I have to begin by asking you, HDFC Bank, we have all seen those false starts. Is this a lot more convincing this time?
Good afternoon. Looking at the banking space and looking at the way HDFC Bank has been moving up, it does appear that these false starts that we had seen for the past 2 years is now not the case. The bank is actually, or for that matter, the entire banking space is doing likely to do better going ahead, simply because you're emerging out of a situation where you will have a better credit growth ahead. You don't have asset quality issues anymore, and all the consolidation that you had seen in the past is done with. And we are going to enter a cycle, an interest rate cycle, which will signal perhaps easing instead of tightening ahead. All these augurs really well for the banking sector as a whole. And therefore, I would say HDFC participating in that rally is something that is also coming out of their own situation. The past legacy issues of HDFC banks are no more there to handle. So it is they're riding the wave, the banking wave that we are likely to see ahead.
All right, so that's the view coming in on the private sector banks, HDFC in particular. We will try and connect with Gaurav in a short while to exactly understand what's actually fueling this rally in the private sector bank, be it Axis, HDFC Bank, ICICI Bank, all seeing good up move in trade today. But Kunal, what's your view coming in, not on the banking space, but on the defensive space? In fact, I want to ask about IT, Pharma. Are they looking much better on the charts right now? Or do you think that it's okay, you can still stay away from them?
No, I think few pockets of stocks are looking attractive. So, for example, from the IT pack, you're seeing Tech Mahindra, Infosys, TCS being stronger stocks this time around as compared to the mid-cap IT space. From the FMCG pack, I think we've seen some mild recovery coming back into the likes of Marico. There was mild recovery coming from Britannia over the last 2 days, but no major patterns which are emerging for the pharma as well as the FMCG pack. Yes, the IT stocks I believe are going through a round of short covering, but I typically sense that this could also be expiry juggling which could be happening into these IT stocks. What could probably distinguish a short covering or maybe closing of positions to maybe a start of a trend could be if the start of the fresh expiry, the July series, also sees many of these stocks getting into a added momentum as well as a continuation rally for themselves. So I think if we see that pattern, say in the first 3-4 days of the July series, then we can be establishing a point that many of these IT stocks have formed a major bottom for themselves. And we could be looking at a much more stronger trend over the stocks over the next 1 to 3 months. So as of now, I believe concentration is more towards the private sector banking names, and especially the likes of HDFC Bank and ICICI Bank, which have made a very strong comeback.
Okay, leadership clearly with the banking space. So let's delve deeper into the subject. We have Gaurav joining in to talk to us about what's really aiding and fueling the rally in the private banks today.
Well, yes, Nifty Bank is definitely one portion which is actually in focus because it has been a show stealer today. If you look at Nifty Bank, it has reached its all-time high. Even if you look at Nifty, banks are one of the leading constituents who are actually dragging the Nifty upwards, and Nifty has also reached its all-time high level. And if we specifically talk about in banks, private banks are buzzing today. And the reason being that if you look at some of the valuation metrics, where private banks have been deprived of the valuation for the last few quarters. If you look at the performance from 4th June, and if you look at the top performer, we have got HDFC Bank, Bandhan Bank, IDFC Bank, Federal Bank, who have actually been top performance since 4th June. And the main reason is that now brokerage houses are also being a little bullish on private banks. So when we talk about some of the private banks, first reason why they are being bullish is that the cheap valuation. Because if you look at private banks, they are actually trading somewhere near their 5-year average, versus if you look at the PSU banks, like when we talk about PNB Bank, Union Bank, Canara Bank, they are trading almost double the 5-year average when we talk about PB ratio. Apart from that, there are recent upgrades that have come come for private bank. So Macquarie recently upgraded target price for most of the private banks, because what they believe is that the ROE for private banks is going to improve, and it could be somewhere in the range of 16 to 18%, whereas we may see some fall in ROE when we talk about PSU banks. And apart from that, there is additional risk of ECL. Lastly, we also have earning season coming in, and if you look at some of the past earning seasons, private banks have already shown some stellar performance. It has been showing some growth which is higher than the PSU bank in terms of the loan book growth. So that could be one of the reasons why private banks are buzzing today. And specifically when we talk about HDFC Bank, ICICI Bank, Axis Bank, they are both gaining in trade. They're up more than 1%. So definitely watching out on how the sector pans out for investors, because this is one of the sectors which was deprived for most of the quarters, and now it seems that they're outshining the PSU banks. So definitely watching out on what happens in private banks in coming days.
Okay, so that's interesting. We'll watch out for the banking space. Tomorrow, of course, the index will be in focus on account of expiry. Today, of course, Nifty Financials goes for expiry for the month. But talking about financials, we did speak with the management of Shriram Finance. That's one of the top gainers on the index right now, up almost 3.5%. Let's listen into the management view, because they're fairly confident that they'll be able to beat the guidance of 15% AUM growth.
Say, ultimately, our business depends upon the economic activity. And as there is more economic activity across urban and rural market, we should be able to grow more than 15% very comfortably. See, basically we are looking at three growth areas. One is MSME, passenger vehicle, and the gold loan. They are likely to grow more than 20% this year. Maybe including even two-wheeler demand also could be higher. So these are all these segments which are likely to grow more than 20%, mainly because the infrastructure, what we are creating to reach out to the larger public for MSME is working out, and also in the gold.
Welcome back. You're watching Closing Trades, still hovering around those record high levels for the benchmark indices. No doubt we're a tad bit off the day's highest point, but nevertheless still holding on to the shade of green as we speak. There's some of these counters which are seeing good up move. Yes, there are battery makers like Amara Raja that are seeing a good up move, still holding on to gains of 17%. You have Garden Reach, Godrej Agrovet that are seeing good gain, especially Raymond. That particular counter is seeing an uptick once again, 6% up move coming in for Raymond, and it's been a good ride for this particular counter. Mahantesh, what's your take coming in particularly for Raymond? And also, if I could actually add Raymond now to the pack of the realty stock as well, because after that, looks like there has been a re-rating for Raymond, isn't it?
So I think the real estate sector is doing quite well, particularly those which are linked to Mumbai city. You would find that among the largest or strongest growing markets for real estate past 2 years have been the greater MMR region, the Mumbai metropolitan region, particularly Thane. In the past, we used to see that the real estate markets of Delhi, Bangalore would grow fast. But particularly, we are seeing in the last 2 years, Thane has been a very large growing market. Raymond has a direct presence in the Thane market in terms of real estate projects. And even from a comparative perspective, Thane has been one of the fast growing real estate markets. So wouldn't be surprised with the kind of development we are seeing on the Raymond stock. Having said that, even the other Mumbai-based real estate companies have been doing really well. Uber Realty is another one. Godrej is another. So I believe that some of these companies exposed to the Mumbai real estate market or MMR real estate market will start tending to do better. And let's not forget that we have new metro projects upcoming now who are just about to start, which would lend a better kind of real estate growth to the greater MMR region.
Companies are coming under pressure. So whether it's Lodha, which is down 5%, Oberoi Realty taking a knock of 5%, Prestige, Brigade, all of them are on the back foot today. So some amount of profit booking after the kind of run-up that we had seen yesterday. But let me talk about what's happening in the pharma sector as well, and let me bring on board a voice that we don't hear very often of late, and that's Ms. Kiran Majumdar-Shaw of Biocon. Listen into her take with respect to the kind of uptick they have seen in the entire biosimilars business and what's the way forward for generics.
Our own generic GLP-1s are very, very interesting in terms of value creation and opportunities, the opportunities that are being created to gain very good market share, because we find that in many of these areas, the complexity of developing such products is giving us a competitive edge. This is a very, very exciting opportunity for us because we are seeing huge demand and huge growth for biosimilars and for specialty generics. And I'm very excited with the kind of the growth trajectory that we can pursue. And it's really about ensuring that we have the capacities in place because demand is growing. We are looking at good double-digit growth for the foreseeable future. And I think when you mentioned debt, yes, we have reduced debt significantly, and we are on that path of further reduction of debt. But the debt is comfortable to service. It's really about ensuring that we gain the kind of market share for our biosimilar products around the world in terms of value maximization.
Okay, so that's a commentary coming in from the management. I know Kunal is very positive on Biocon, but let me take it across to Mahantesh to get his view as well on the stock. Mahantesh, do you track this one actively?
Track Biocon, so wouldn't have much commentary there. But having heard Kiran Majumdar-Shaw, yes, the generic space is something which is set to grow. But we have to remember the backdrop that some not too long ago there was a lot of pricing pressure that was being witnessed on the generic side, particularly in the US market. I guess that pressure is now gradually easing, and therefore you will see better growth ahead.
Let's talk to the person who has a bit of a view on it a bit more. Kunal, you've been fairly positive on Biocon.
Yeah, bullish on Biocon, and I think even at current levels, I would believe it looks attractive because the stock has not yet started a major uptrend. It's just given flashes of breakout on the short to medium term charts. But I think the major hurdle still is at around the 355, 360 mark. I think if I'm not wrong, the all-time highs for the stock is above 400 plus levels. So I would believe that eventually the stock should be able to scale past above those kind of highs for itself. The only concern which happens for Biocon on the short-term basis is the stock, at least in the last few expiries, used to get into the F&O ban, which dampens the mood or the sentiment for the stock on an immediate basis. But I think other than that, it's a very strong and a bullish chart, and would continue to have a similar stance on the stock.
In the last few minutes, there's a further perk up on Craftsman Automation. Apollo Tyres is actually seeing a bit of a perk up. That entire auto hangs, to be honest. Amara Raja Batteries has been flying since the word go. But you also have a lot of other names, even Electra, Greentech, etc., JBM Auto. All of these stocks are perking up. And one of the reasons could be perhaps what my colleague Sumit had put on board. In terms of the budget expectation, it seems like that the auto industry is also watching out for some sort of relaxation in terms of the tax burden that we have. In fact, let's take it across to Sumit to get a sense as to what the expectations are for the auto sector from this budget, and is that the reason some of these stocks are buzzing? Sumit.
Auto component sector of India is aiming for a big relief for them in the budget, upcoming budget, and they have released some of their demands. Well, this includes, first of all, increasing depreciation on assets including plant and machinery from 15% to 25%, and bringing down GST rate on EV and components and battery parts from around 18% to around 5%. Well, GST part definitely comes under GST Council, and the meeting decides it. However, they are still hoping for some relief in budget budget from that. PLI, the production linked incentive schemes, have also given overall relief to the auto component sector, and they hope this scheme will be continued and be made more flexible to give them more leeway when it comes to asking for more relief from the government. So these are the main demands made by auto component sector. And they are also saying that it will help them. The savings in GST will help them, and also in depreciation on plant and machinery will help them in making more and more capital expenditure. We're also learning from our sources in the finance ministry, some of this can be given as well, because auto component sector is a big generator of employment, gives a lot of jobs as well. That's why some of these demands could be met in the upcoming budget.
All right, so that is what the auto ang sector is demanding. But Mahantesh, let me come to you. And since we are talking about auto ancillary space, which one are you liking the most in that particular domain? Because it is quite a vast domain, isn't it? You have the ones that are into making the rims, into the wheel segment, as well as into the engines. And you have Amar Raja and pretty excited on that particular front.
So when you look at the auto ancillary space, and I do agree it's a vast space to really cover, but if you spot the trends that are happening, whereas which is coming out of how the overall automobile industry is developing, is one, there is premiumization that is happening. That means more and more people are buying higher end kind of cars, which calls for greater, therefore, content per car that is coming in, which obviously augurs well for some of the auto ancillaries. Point number two, in terms of trend number two that is coming up, is that we are seeing some kind of policy consensus coming towards junking of cars, basically doing away with old cars, and therefore that should start a very healthy trend in terms of overall automobile growth. The third trend that we are witnessing is that the overall driving the experiences of vehicles is technology driven, getting technology driven. There is a lot of integration that is happening, tech integration that is happening within automobile space, and therefore some ancillaries stand to benefit out of that. So if you want to pick of all these trends that are happening within the auto ancillary space, the trend that seems to be the strongest is the trend number three that I identified, which is linked to the increased automation and increased technology usage within the automobile space. So you actually start looking, therefore, not really in the auto ancillary space, but looking at engineering services kind of companies who are in the auto space. That should start doing really well going forward, and not necessarily just the pure auto ancillary space alone. But the auto ancillary space that can do potentially well are the ones who have large replacement markets to look forward to. Tires is one of them. Batteries is another segment which are not really OE dependent, but on a lot of replacement demand dependent, and therefore fits well with the overall growth theme that happens, which is linked to the junking of old cars, etc. So we'll look at these spaces: engineering services space and the replacement market driven kind of space.
So that's the view coming in on the auto sector. In the last few minutes, some of these home finance companies have actually seen a perk up. So Canfin Homes is up, LIC Housing, for instance, and Home First Finance. Let's pull up all of these charts and see. Yes, so in all of these stocks in the last few minutes, there has been that additional buying that has come in. Naresh, what's the view on some of these stocks? Would you be buying the likes of Home First, Canfin, LIC Housing, or any other name?
So the whole basket looks interesting because major price points are being taken out. So if you look at Canfin Homes, the stock had last time topped out at 900 almost a year back. Since then, the stock consolidated for last 10 to 12 months. And now we are getting close to a breakout about 900. LIC Housing similarly, after that breakout about 680, 700, is now in touching distance of an all-time high, which is closer to 800. So the structure is pretty positive. Home First also, although the data is not much, but hit a new all-time high. So structurally, it remains a buy on dips, the whole housing finance sector as such. Even a PNB housing looks good.
Okay, Nuresh, point taken. Those are the top recommendations coming in from the housing finance companies. But time now to slip into a very quick break. Don't go anywhere. Lots lined up when we come back.
If you like this video, then like, share and subscribe to ET Now.